Hey, everybody. Thanks for joining us. My name is Will McBride, and on top of me you see is Dmitry Pargamonic. He's the King Chameleon. I
Hey
am
guys.
one of the co-founders. Dmitry and I have worked together for years. The big screen in the middle is the disclaimer. Please take a chance and read that. The bottom are the questions, the polls, the offers. As we go through today's webinar that Dmitry has worked really hard on putting together this week, open interest explanations, tricks of the trade. And put any questions in there and we'll get to them at the end of the webinar. Thanks for joining, everyone. And I'll let Dmitry now take us on the path.
Yeah, and we put a poll down below, and just helps us know if you guys see if you're beginner, intermediate, or advanced. This way, it just lets me know, how to navigate during the webinar. But Will, if you can just put up the slide.
Yep, that's you, Dmitry. Did you click it in? So also, guys, when you're asking questions, click on the questions down below. I see there a bunch of them entered, just so click them. And I assume everyone, our sound, everything sounds all right. No one's complained yet, so I'm assuming we're good to go. All right, there you go, Dima.
Everybody could hear us okay?
No,
yes.
No.
Yep.
Everyone's saying good.
All right. So with this webinar, I'm going to talk about open interest, and we're going to just get into like a question and answer. And really what I did was just take the top questions I usually get either by email, on chat, or when I'm talking to people on the phone. So let's just get to the questions. The simplest one is just what is open interest. I'll go quickly through that, but just want to make sure that I cover that part. The other question I usually get is, how often does open interest update? Is it like real time? The next question I get is, how do you know if someone is buying or selling looking at open interest? And then people ask me, well, how do you use the open interest? What is like a strategy? So the first thing I'll go over is just what is the open interest. And unlike stock, when you think of a stock, it has outstanding shares. So you'll have like 100 million shares outstanding, whatever the price is, like say $1, the whole company's worth $100 million. That's its market cap. So if you bought all the outstanding shares, you basically own the company. But options are different. There's no such thing as outstanding shares. They're actually like start out as zero. It's a contract between a buyer and a seller. So until something trades, it's really zero. And when a contract trades, the person who's buying has a right to either buy or sell the stock in the future. The person selling has that obligation. And that's basically how open interest works is, options are listed. They start out with zero open interest. When a trade happens and somebody creates a position, that's when the open interest goes up until either both sides close out of that position or they expire or they exercise those options. So going to that next question is, how often does open interest update? Because a lot of people think that open interest is updating real time throughout the day. And open interest actually doesn't work that way. The open interest is calculated by the Options Clearing Corporation. They clear all the options, guarantee all the options. And what they do is, after things are trading throughout the day, they look at the settled trades at the end of the day. Then they take into consideration any exercises, any assignments, splits, and then they reconcile overnight. And then they tell you the next morning what the open interest is. So here, I just went here. This is the Options Clearing Corporation. So you could see here, open interest figures are derived from the previous day's settlement. So for example, Friday's figures are from the Thursday. So in the morning, when you see Friday's figures, that's following Thursday's close, all the clear trades, anything that's either exercise, assign, all that's taken into consideration to make a new open interest. So moving on then to the next question is, well, how do you, and I always get this question, how do you know if somebody's buying or selling? So you look at the open interest, then, is somebody buying or selling? Now, there's no such, every time, whenever something trades, there's always a buyer and a seller, right? So there's no such indicator as bought or sold. Every trade has a buyer or seller, and then the trade just gets put up on the exchange. But what we do is use inferences of what people may have been doing, right? So we'll have to infer, maybe using the open interest changes and the implied volatility in the options, to infer what may have been happening yesterday in the options market. So first, let's just take a look at the open interest, and then we're going to look at the implied volatility. And when we look at open interest, if open interest is increasing, so if we see the next morning that open interest increased, then the assumption is that new positions are opening up, right? They're building up positions. So if you either, you start out at 0, if 5 options traded that day and nobody closed out of it, they weren't exercised, you'll see an open interest of 5. If it goes up, more trades happen the next day, it goes up to 10. So as open interest is increasing, that means people are building up new positions. If open interest is decreasing, then it's the other way. People are either closing out of the positions or they're exercising their options, getting a sign on it. So then the positions overall are decreasing. So then we have to couple that with implied volatility. And when we look at options are priced based on implied volatility. So it's not like a stock. We've determined options are kind of priced in implied volatility terms or in premium terms. So if implied volatility is increasing in the options, then the assumption that we're making is that there are more buyers than sellers, right? The premiums are moving higher. If the option premiums are decreasing, right, implied volatility is going down, then we're making the assumption that there are more sellers in options than buyers, because the implied volatility is going down. And let me just take a look before we go into that into the strategies I brought up, for example, SPY. So here, this is open interest analysis in SPY. And here you could see for each individual option, you'll have a short buildup or long buildup, long liquidation, right? And what this means is that the buildup means that the open interest is increasing, right? That's what we refer to as buildup. And short means that as the open interest is increasing, the implied volatility is moving lower. So in other words, we're looking at it as open interest increasing, implied volatility is moving lower. The assumption is there are more sellers than buyers, and they're still increasing positions. Long liquidation would be that the implied volatility is increasing because it's increasing, but the overall open interest is decreasing, right? So when the open interest is decreasing, people are getting out of their positions or they're exercising. So this is kind of how it would look like by line, and there's an explanation here. So this gives you kind of an overall picture of open interest. So then let's get into let me come back here.
Hey, D?
Yes.
It looks like we may have had a problem with your, I'm seeing you.
Yeah.
We're getting some comments that people aren't seeing the screens or the slides. I'm wondering, does everyone see the slide now?
You know what? Let me see. Let me share 1 second. 1 second.
Yep.
Do you see it now?
Yep, everyone's seen them. So why don't you go back?
Okay. So I'll just explain it one more time then. So this is an SPY, and I just brought up open interest, and these are in the different expirations here. And what we're doing is looking at each individual line to see what would happen from the previous day, so we can make an assumption like what was the trading activity and what do we think occurred, right? So we're just inferring. So over here, for example, when we see buildup, what this is telling us is the open interest increase from the previous day. So these are the open interests, so they were increasing from the previous day. So new positions are being opened up on these lines. Short, right? Short would say that, well, which way do we think they're building up? Are they buying options or selling options? Well, with short, if the implied volatility is decreasing, then we're saying, then the assumption is that there are more sellers, right, pushing down the options than there were buyers. So that's what a short buildup would look like. Long buildup would be the opposite way. When the open interest is increasing and the implied volatility, these would be increasing. That would be a long buildup because people are increasing positions and the implied volatility is moving up. In other words, more buyers than sellers. So that's kind of the assumption here. You go line by line to see what occurred the day before. Does everybody see my screen? Is that okay?
Yeah, it looks good.
Okay, so I'm gonna go, can we go back to the slide, Will?
Yep.
So I'm gonna go to the slide over here. And so then what do people ask is that okay now? I see people are saying it was blurry or buffered. How's it look now?
It looks fine. Some people are having problems between their Safari and Chrome.
Okay.
You know, just letting them know to refresh. A lot of people are good. Some people are having problems. I would just bull through this, Dmitry. You're doing great.
Okay. All right. So over here, the next thing people ask is, well, how do you use open interest? You know, like how do you put that into your trading? That's what and I promise there are two tricks that people do use open interest. And as market makers, you know, we saw this happening and we understand it. So I was going to show it to you. And then there's a couple different reasons why I want to show you these particular ones. Before I even show you the dividend spread and interest carry, when you look at open interest or any kind of data, people can use it for many different reasons. There's no like one strategy, you know, you always put things together. So for example, you might want to look at open interest, you know, if you have a strategy, like say, you know, that earnings were released yesterday, right? We know that implied volatility after earnings are released, they start to come in, right? They get crushed. So if you're looking at the markets and you might think, well, you know what, I think that implied volatility should be much lower and maybe, you know, 2,000, you know, contracts traded on this line, you might want to look at the open interest, say, well, there's like 15,000 on the open interest and a lot traded yesterday. So, you know, there's more to go, right? So, you know that even if you sell that implied volatility, there's probably pressure behind you. And these are like just one example of many that people will use in their analysis before they want to do a trade. They might just want to look at the open interest and see what went on that particular line. But I'm going to explain right now a dividend spread and interest carry, and I'll tell you why at the end why I wanted to show these two in particular. So a dividend spread, it looks like this. When people look at it, when you look at you're going to look at an option in a stock, right? And you know that in a stock, and let's just say here, a stock is $100, and you know tomorrow it's going to have a dividend of say $1, okay? And let's say, you know, you look at an option that is way in the money, deep in the money, like a 50 strike, right? So it's already $50 in the money, and you could sell. And for example, that option is $50, right? So if you buy the stock, sell the call, right? You buy the stock, sell the call at 50. This is a 100 delta option. In other words, if the stock increases by $1, you make $1 on the stock, you lose $1 on the option. If the stock decreases by $1, you lose $1 on the stock, you make back $1 on the option that you sold. It'll go from $50 to $49. So in this situation, what you did was you're delta neutral. What we call is like, you know, you're delta hedged or delta neutral. And what happens is right before, if you own that stock right before the X date, and you hold it through the X date, and that option does not get assigned to you, and somebody forgets to exercise it, Well, what happens is that the stock that you own, because you own the stock, you will receive a dividend. And then whatever happens between the stock and the option, those deltas will offset. And at expiration, let's say you pick an option 2-3 days to go, that option will take away the stock. So you basically break even between the stock and the option, and you isolated the dividend. And that's called like a dividend spread. And let me see if I could actually show. I'm going to try to. Am I still sharing my screen?
It's there. Do you want me to?
Do you see the JP Morgan screen?
Yep, I'll bring it up. There it is.
Okay. So it looks something like this. I think JP Morgan, had a dividend on the 1st or 3rd. Let me just see that really quick. So I think it was on the 3rd. So go the day before, right? On the 2nd, this is what it would look like. And you see here open interest. So you see a bunch of open interest that are way in the money, right? So this is 84, 1 day to go, So somebody might forget to exercise these calls, right? And you could see how some people are already trading in them, right? What is the objective is if you sell the call, they're doing it, remember, at parity, you buy the stock. The next day, if somebody forgets to exercise it, you have 1 day to go, the stock and the option will offset each other, and you isolated and you kept that dividend. Basically, you extracted the dividend in this strategy. Does that make sense, I hope, to everybody? I'm going to go to the next.
Unfortunately, the screen's a little blurry, particularly on some people's, maybe if they're using Safari and not Chrome. I saw it reasonably well, but that seems to be the comment from some.
Okay. Well, let me come back then to the slider and show how it would look like in a slider.
All right, I'll pull the slider up. There you go.
Right. So in other words, you own the stock. You own the stock. You're hedged with the call option, deep in the money. They move 1 for 1, right? So what you're going to lose, whatever you lose on one, you'll make up in the other. It's in the short term, whatever. And what you're doing is because you're long the stock, you extracted that dividend. That's called a dividend spread. And the reason people look at the open interest is because the higher the open interest, the more likely, right? The more likely that somebody might forget. Now, I'm not saying you go do it. It is unlikely that this would be a strategy for a retail investor, but that somebody's saying that that's the dividend spread. Exactly. That's a dividend spread strategy that you'll see sometimes, trading in very high volume. You could even look it up. There are lawsuits about it if that's even legal for market makers to do. And I'll explain to you why why I even brought this up. But let's look at the reverse. But the idea here is you're going to be looking at open interest because you want to see where there's a lot of open interest in an option that is an exercise and somebody is likely to forget. Going to the next slide, let's do the reverse, right? The reverse would be, what if I sold short a stock and I saw a deep in the money put, right? So let's say the stock is 100 and I saw a put that's 150 strike and there's open interest. Somebody forgot. So that's an exercise. That's an early exercise. So here you would see the opposite strategy. And I'll explain to you why you would want to do this. You sell short a stock, right? So you sold short a stock at 100. You sell the put, the 150 put, let's say at parity. If the stock moves down, let's say $1, you lose $1 on the put, you make $1 back on the stock that you're short. The stock moves up, you lose $1 on the stock that you're short, you make $1 on the put that you sold, right? Now, the reason people do this strategy, and this would only exist when interest rates are higher, but essentially you have a hedged position. It's moving up and down, perfectly hedged. I'm not going to move over to my options chain, but remember when you short a stock and you sell an option, that's money coming into your account. So if that money is in there, and assuming your broker pays interest on the money that's inside your account, you're basically making a interest-free loan to yourself, right? You're borrowing that money at zero, and then you're earning interest on it. Now, of course, to do that, you would need to find where there's open interest in a deep in the money put. You have to make sure that the interest rates are you're not, if you're getting 0% interest rate, it doesn't work in your account. But you have to find where somebody forgot to exercise their put. You could sell, and if you're short that put, short the stock, you're hedged delta, you're delta neutral, and while that money's sitting in your account, you're earning daily interest on it. And the reason now I'm just going to explain to you the reason that I showed these two, the interest, carrying the interest and the dividend, is because as professional traders, or as you guys start to kind of expand, a lot of people who come to us think in terms of the way to make money is the stock has to either go up from today's price or go down, right? And that's how a lot of people think. But from our experience, we've been trading on the floor, most of the time you're looking at how to isolate an edge. So in this situation I just showed you, this is where you just isolated a dividend, right? You try to extract the dividend. You weren't looking for stock moving up or down. On the contrary, you didn't want to take that risk. And on the opposite, you were just trying to isolate that interest that you would earn. You weren't interested in the stock moving up or down, but more you start thinking in dividends, interest, delta neutral trading, because a lot of option strategies are delta neutral, or you start looking at strategies that profit not from either the stock moving up or down from today's price, but more in like a range of prices, right? Like, what is my strategy that I profit from a range of prices, and what are my probabilities around those prices? So the one last thing, I'm going to try to go back, Will, to my screen.
All right, bring it up, and when you get there, I'll click it up. All right, it's up.
Okay.
Yep. We see the SPY again.
Right, and this is just an SPY. I'm going to just go up here in general terms. And when people look at open interest, just like stock volume and stock prices, you might want to see like, well, what's today's open interest, and how high or low is it versus historical? So here, this is 98th percentile, meaning in the last year, 98% of the time it's been lower. And here's the 52-week average, which is telling us that there's a lot of open positions now. It's not that surprising, because there's a lot more volume now with the volatility. But this is another thing, even stock by stock, to kind of get an idea. Is there a lot of open interest, a lot of positions open? Same thing here for the calls. You can move, and the puts, you could compare the averages. And another thing people like to do is look at the put call ratio. So over here, today it's at 1.6. The 52-week average is 1.8. So this is in the 12th percentile. So actually, on a relative basis, the people are now tilting towards more calls than puts on a relative basis. Still more puts than calls, but the average is 1.8 versus 1.6. And we see that volatility is coming in a little bit. So that's just telling me that the skew is starting to straighten out. In other words, that if volatility is coming in and then we're seeing that put call ratio tilt, the skew is probably in the puts starting to come in, and people are looking at at least the short-term downside risk as subsiding a little bit. Okay, not completely, but a little bit. Or if the market goes down, it's not going to go down as fast. It might go down slower. So I'm just going to come back to that slider, and I kind of wanted to go a little bit quickly through all this so I could answer questions, because I know,
all right, the slide's up.
More time. Okay, and I usually just wanted to leave more time for questions. So
While you're saying that, listen, everybody, I know we're getting lots of questions asked in the chat. Just make sure you go down to the bottom on the left-hand side and click on the questions and put your questions in there. I'm trying to let people know as they're asking questions in chat to do it, just so they're in the questions box so Dmitry and I can get to them when we start the question and answer session. All right, D, all yours.
So I see one question, how to use open interest walls. I'm not sure what the walls are. Maybe you could explain that further. I see, let me see, the companies had the right to buy their own share, specific price, and right to sell their stocks at premium price at same time. I'm not sure, Mirage, I'm not sure what that question means. Did the audit try to remove unsustainable companies of stock? I don't know what this question means. Let me just keep moving on because I have one person posting a lot. How to filter out open interest increase? It's not due to earnings. Okay, so let's take a look at that. I'm going to go to the open interest here. And let me see here. And let's see if we could do that by symbol. Right. So over here, we could just see, different open interests of people building.
Hold on one sec. I just got to bring that screen up again. All right. It's up.
Right. So if you could see that this here, by symbol, you could do by expiration, but here.
D, can you just bring down where you got that again so people can see it? Because it wasn't.
Yeah, so I went under options and the open interest analysis over here. And really, if you just want to see the total, total interest change, so we could just say open interest increased by like 15%. And I think he said that it's not due to earnings. So you could just maybe do something like this, that the earnings, are upcoming much later, something like that. So I don't see anything popping up right now, but you could do it this way. Let me jump back to the next question. Seen slides. I can't see. Is this recorded? Will, I think we're recording and we're going to send it out.
Yep.
Later. Yep.
It is being recorded. It will be emailed to you from Webinar Ninja, the host and entity, and we will work on getting it on YouTube as well, on our YouTube channel. Anyone who hasn't registered for the YouTube channel, I would do that. But it will be in both places, emailed to you and available on the YouTube channel.
Okay, and then here's one question. If I sell puts, how does that affect open interest? Open interest increase or decrease? So it's either going to increase it or keep it the same depending on the reconciliation, or, but since you're opening a position, right, you're probably contributing to increase in open interest, but not necessarily, because once the open interest is out there, it all needs to get reconciled at the end of the day. So you might have just taken over somebody else's position, and it depends also on the exercises and assignments. Let me just pop back to the questions because they're moving around. I think there are two parts to that question. All right. Do you see it, Will?
Well, I think that was Rob or Lawrence, but the next one right below it was in the dividend spread. Is it just gamma risk with the expiring option? Then if some reason there is news and something that makes the stock move huge, I guess he's just asking the risk to the dividend spread.
Right. So, right. And that's a good question, because in the dividend spread, what you're essentially doing is you're short and out of the money put, right? So you're short a very far out of the money put. And the way, and I could kind of jump back to it. And if the stock does drop significantly the next day, If it does do that, then yeah, that is your risk. That's why it has to be very deep in the money, and you have to make sure, feel comfortable that there's nothing there that can make it drop significantly. But it becomes an early exercise because, like, for example, I think in JP Morgan, the put was 90, I'm sorry, the dividend was 90 cents. So if you could buy the same put on that line, like for 2 cents or 3 cents or 5 cents, you really just, you just created, you're basically hedged off that put, right? So if you got 90 cents, you buy for 5 cents. But yes, you are selling away deep out of the money put, and you're selling it for price. You want to compare it to the corresponding offer on the put in the same line to make sure it's an exercise. But you do have that 1 day gap risk, right? That if it opens down significantly, like $50, then that's your risk in that put.
You're on the dividend spread. Eric is asking why we said the dividend spread is not a great strategy for retail investors.
So to the people who do the dividend spread, right? They do it in very large quantities between two. It's usually market maker to market maker, or market maker to a hedge fund, and they do it in very large size. So they're actually probably capped by their clearing firm on their expense of assignments and commissions. And really, you need two people trying to do the same strategy. So let's look at prearranged trade. You need two people that are willing to do the spread with each other at parity, right? So it's exactly at parity on both sides. Exercise the long side and leave the short side on, hoping to get away with it.
Yeah, your voice is a little scratchy there.
How is it now?
It's still a little scratchy for some reason. I'm not sure. I was hearing it too. We've got a few people mentioned it.
Okay.
Sounds better now, though.
Okay.
I had a question from our buddy Danon this week. I don't know if it's something you can look at.
Yeah.
He was on the homepage of Market Chameleon, and it was actually Apple was popping up as an opportunity. I don't know if it was an iron butterfly or a condor, but he was asking about the edge number on our trade screens. Can you maybe explain that to our friend Danon?
So the theoretical edge itself, we're kind of getting off the open interest, but the theoretical edge, do you see my screen right now?
I do see your screen. Unfortunately, it is a little blurry.
Okay.
Hold on.
I'm not going to go to the screen, but basically the theoretical edge creates a benchmark to trade around, right? So what do you think theoretically this option or this strategy would be worth in the long term? So are there people complaining that they can't hear me?
Yeah, they're saying someone recommended, I don't know if you have a cell phone near you, but sometimes that can affect the audio.
How's it now?
It's a little bit better.
Okay.
Back to talking about the edge.
So basically, the edge number, it creates a benchmark to trade around based on historical movements, historical data, and we have a bunch of videos out there explaining that. So you can either go on our YouTube channel, or if you hit that button on video, right on the top next to the menus, you'll be able to find that. And then there's a video that explains it. But it'll probably take me too long right now, and I don't want to move around the pages.
All right. Sounds good.
All right. I do see looking for ways to use community tools when option Bidask is extreme, high VIX like Corona. So I see Mike Chandler. I think he's looking at not open interest, but I think that he's looking at ways to use for the Bidask Bidask is extreme, maybe when the options go very extreme. Is that right, Mike? Okay, I don't know. I don't know why people are complaining, but
You know what?
Yeah.
Is refresh your screen. We'll lose you for a second. Let's
Let me
try
to refresh. Okay.
So we're going to try to refresh Dmitry and bring him back here, everybody. You can, again, put any questions. We'll get to them. Left-hand side, click on it, put the questions there. Listen, if you have any ideas for shows, we're going to try to make this a Sunday occurrence. So just you can email support at Market Chameleon if you have ideas for shows going forward, things you want to see in the Chameleon, things you want to hear from Dmitry. We would gladly do it. So just drop an email and put my name in the subject, Will McBride, ideas for shows. You back?
Yeah. Can you hear me okay now?
I can. And I
you want
see
to just read me you want to just read me the
questions?
Different questions? Yeah.
Yeah, let me go to one.
All right, maybe it just had to clear.
All right, well, Mike Chandler was asking, looking for ways to use the Chameleon tools when he's looking to use the Chameleon, I guess, to identify bid-ask spreads that have moved to extremes. I'm not so sure we have something like that, but he's asking a question relative to the bid-ask spread.
Right. Well, some of our, and a lot of our screeners, for example, they might have a bid-ask spread filter in it. I know that when you're looking at the large options trades, there's a bid-ask spread there. But I think if you're just looking at comparing what the bid-ask spread is today versus like a historical level, we don't have that. Like, are they 10%, 20%, or 50% wider? We don't keep track of like a daily bid-ask spread. And really they'll widen out certain parts of the day, maybe, or when there's volatility, they'll tighten back up. But if you're looking at just like benchmarking and versus a historical level, we don't have really anything like that.
Well, it is interesting. This is something everyone should be aware of. Rob actually posted a comment underneath that said, what it's worth, from my experience, it's best to stay away from huge bid-ask spreads. And he's right. I mean, as a customer, the last thing you want to try to do is enter something with real wide spreads, right? It's hard to, you're going to give up a lot of edge getting in,
Right. So. The only time I think you could benefit from wide spreads is if you're going to be a liquidity provider, or if you're going to stick out a limit order there, like say you want to, let's just say you want to sell a put, right? And the markets are really wide, like $0, $10, and you think this put is worth like $1, maybe stick it out at $9, right? Because there's no liquidity. Yeah. Maybe you get hit.
You're absolutely right. And
right.
Then the other side being, when you get in, you're not going to get in on the bid, right? You got to put it in between. It's got to be wide enough both sides to be comfortable with it.
Right. And if the markets are very wide, then only if you want to step in as a liquidity provider, or you want to provide a limit order out there that's going to take advantage of illiquidity and wide markets, and you'll say, okay, well, if I get hit, if for this put that I think is worth $1 for $9 because everybody else is wide, then that from that you might be able to benefit. But if you're trying to actively trade and put things in between the market or whatever, you might want to be careful with what you're doing.
All right, we have a question relative to the put call ratio. Yeah. I don't know if you want to answer anything relative to talk about the put call ratio at all, but that's up to you.
Yeah, what's the question?
He just says, do you believe that, this is from Lawrence, do you believe that the put call ratio tells you something about a possible move in the stock?
You could do we didn't do the analysis. You can do the analysis, but I don't think so. And I think that a lot of people, and that's why I showed these two examples really quickly, is that people will tend to think, is the stock, that every piece of information you use is going to tell you, is the stock going to move up or is it going to move down, right? And And I'm trying to move away from that and teaching people that options traders or even professional traders, they don't think necessarily in those terms. Like when we were trading and creating, creating models to trade, it was almost always delta neutral. It had nothing to do with trying to predict if the market or if the stock's going to be up or down. Sometimes we get biases, but it wasn't based on that. It was based on, extracting an edge. It could be volatility, because the volatility is too high or too low. You trade delta neutral, the cost of carry, the dividend, the interest rates. Maybe something's far away from its net asset value. Maybe something diverged very far away from a norm, and you could hedge some of it. But the idea is that if you're only thinking, stock going up or down, you're probably missing out on like the best part of trading is putting pen and paper together and trying to figure out different parts of edge. So like the ones I showed you, with the dividend, it had nothing to do with direction. It didn't matter if the stock went up $1 or down $1. You're extracting a dividend. The one with the put spread, it didn't matter if the stock went up $1 or down $1. You're looking to benefit from the interest. And I think we'll talk more about how to trade delta neutral and actually move away from, you don't want you don't necessarily want that risk. Is the stock going to go up or down, right? You're trying to get rid of that risk, hedge that off, so you could extract an edge somewhere else. So for example, the difference between implied volatility and realized volatility.
Cool. All right. We have, I may be mispronouncing, I think it's Nihilish. He is asking, is it better to make trades, he refers to them as bets, using theoretical edge or win rate?
Well, there are two different things, and I did do a video on it, but and I'll just go really quickly over it. And a win rate is this: like if you had a wheel, right? If you had a wheel with numbers 1 through 10, and I told you any number from 1 to 9, 1, 2, 3, 4, 5, any number from 1 to 9, if it lands on that number, I'll pay you $1. Well, that means your odds of winning are 90%. 9 out of 10 outcomes, you're going to make money. But if I told you that if it lands on 10, you have to pay me $100 or $200, well, now your win rate's 90%, but you have a negative edge trade, because if you keep playing that game, you're going to lose money at the end, right? Because every time 10 lands, you're paying me $100 or $200, and I'm just paying you $1, from 1 to 9. So those two things, you could look at them, but they're two different statistics telling you two different things. So it's even possible
Great.
a 10% win rate might be desirable depending on what your expectation is of your payoff, in the long term.
All right. How can I use OI volume? How can the OI volume be used for an edge in my trading?
So right there, I just showed two ways people look at open interest. It's when you're looking specifically to do something, you use it to assist you, right, in your trading. So for example, when I showed you the dividend, that dividend spread, it assists you because where is somebody maybe forget to exercise that option, that I'll extract the dividend. In the put, it's the opposite. Where did somebody forget to exercise the option because of the because if you short that stock and the put, you could earn that interest rate. So you're just assisting your trading using the open interest. It's just one little thing. I also mentioned, like, for example, if you're expecting a lot of liquidation in an option, right, and you're thinking that the implied volatility is going to come in, and let's say you think the implied volatility after earnings, it's 100, it should come into 50 vol, right? And right now it opened up and implied volatility is at 80, right? Well, you could look at, 2,000 contracts traded on the line, but there's like 50,000 open interest. So, there's a lot more to go. So that kind of gives you a little bit more information saying that I feel more comfortable if, because I know there's more behind to go. More people have to liquidate their positions, and I have an approximation how much, that are behind me. It could go the opposite way too. If there's a lot of open interest in implied volatility, they're wrong, implied volatility is moving up, some of them are going to have to close out. So these are things that you use to help assist you depending on what you want to do. That's when you want to look at the open interest.
Great. Another open interest comes from one of our favorite chameleons, Mike Chandler. It says, when we see the chameleon find open interest changes, are they all reported on the main page for subscribers? Question. In the various Twitter feeds? Question. Is there an overlap between feeder leads and subscribers' main page? Just different ideas, I guess, when trying to find open interest changes.
Right. So the open interest, it updates approximately, I forget exactly what time. I think it's like 6:30 or 7 a.m. Right. And depending on so if you go to like the options chain or the open interest page that I showed you, it should update in there, as soon as we get that data from the vendor. But other places such as our screeners, like Stock Screener, for example, it will not update until the market opens, because the driver of those screeners are the market data. When the market opens, everything starts updating. So this way we're not updating, things at different times, right? Like some things we don't want to update. We can't update something, at 6 a.m. The other stuff updates at 9:45. So if it was like a stock screener or options trade screener, that will kick off right after when the market opens and we start getting data. But if you go to the options chain or that open interest analysis, that will update. That will be updated. If it's open interest specific, that will update. I forget what it is, maybe like 7 a.m.
Good stuff. Steven asks, in a thick symbol like TLT, I often cannot get filled, even if I'm trying for less than the spread midpoint. He's asking, what's going on?
I mean, I don't know, without seeing the details, I don't know. But if he's putting it in between, not getting filled, then, there's no interest in between.
Yeah, well, that's it, right? If you're not getting filled, there's no interest.
Yeah. Any more?
Yeah. Nilish asks another question. Does it make sense to use theoretical edge to place a trade compared to win rate? But I guess you already answered that.
Yeah, I think we did that one.
Prasna asks, can we use the open interest data for potential trend reversal direction?
So I've never used open interest as a predictor of a direction, right? So I've never used it. I've never seen any kind of evidence that there's a predictive power in open interest as a directional move. But people do use open interest for different reasons, like I stated, or they might look at things like pin risk. They might look at, if they're doing risk reversals, conversions reversals. If they're looking at gamma risk, like where are the lines that could break through that have a lot of open interest that could potentially, what it does is it'll spark like a rehedging event or a gamma event, right? So a lot of people are short. If it breaks through, that could be, then it could just flush out, because then you have a lot of covering going on. So people will use it from what I've seen for those purposes, but like just to predict if the stock is going to move up or down the next day, I've never seen any evidence that open interest can help with that.
Interesting. John asks a question. Can options really be considered investing, or would you say it is closer to gambling?
Well, options are certainly not an investment like you buy a stock and wait 2 years, 3 years, because options but they're short term, right? So you have to trade them if you're doing monthly or quarterly. You're trading them, and if you're just outright, you could gamble with them for sure, right? You could just buy call if you think the stock's going to go up. You could buy put if you think the stock's going to go down. So you could use them as gambling instruments, you could use them as hedging instruments, or you could use them as strategies of where you think in the short term what is the most likely outcomes in the stock, and then strategize around that. But it's not like you don't hold options, like you don't have a portfolio of options like you would in a stock, right? Because these are contracts, so you'd have to use them for a particular purpose other than like investing. It's not like there's no fundamental analysis in an option. It's a volatility.
That being said, someone who's running a buy right strategy is looking to increase their yield if they already own the stock, and that may be considered an investment strategy.
Right, like somebody will use it like maybe to buy right. So people who own stock might buy right. That's a strategy. So some people, instead of even buying the stock, they'll do like credit spreads or sell puts or do something like that, where they rather do it in option premium than just hold the stock itself. But options, they're riskier. And if you're just outright trading them based on stock movement, then you're definitely gambling and speculating. So if you're just buying an option because you think it's going to go up, or you could have a good reason, you could think the option is undervalued, but you're really looking at direction, magnitude of the move, and it has to happen by a certain time period. So it depends how you're using it.
We got someone who sadly joined late. I'm just typing in, letting him know we will post on YouTube. But Robert Fox is asking, how do you determine if the OI is due to buying or selling?
Right. So there's no, and we went over, but there's no every trade has a buyer and a seller, right? So there's no official indicator. This trade was a buy or this trade was a sell. A trade is a trade. There's a buyer and a seller. So the only way we could do is we can make inferences, right? Like just like in a stock. So like, for example, if there's a lot of volume in a stock and the stock went up, then we could infer there's more demand for the stock that day, right? There are more buyers than sellers. In the options, we do it because options are priced in implied volatility. We would look at, well, what happened to the open interest and what happened to the implied volatility. So we could kind of infer that there were probably, if implied volatility was going up, open interest was going up, there were probably more buyers than sellers. There's a higher demand for premium.
This is another one from Lawrence. Hey, thanks for all these questions, Lawrence. I often see some strikes with open interest that is much higher than other strikes. He's asking, what can I read into this? What is the reason for this?
Well, those are that's where the open interest is. In the beginning, remember, open interest is zero. So until somebody, creates a position and is holding that position, then the open interest is just zero. And if there's a big trade on a specific option or specific strike, they're holding a position. So that position is either, at some point, it's either they're going to carry it till expiration, or at some point they might want to close out of that. But at least you see where the open interest is, where there's trading on that line, and that if you see that open interest, it's so far it hasn't been closed.
Jim, it's the last question on the board. Do options have dark pools? Seems sometimes no recorded volume, the next day huge increases in open interest.
So options don't have dark pools. The stocks do, but in the options market, they don't have dark pools. So it has to go through the trades have to go through a lit exchange. Now, sometimes there are trades that are negotiated on the floor of the exchange. So broker will come into the pit and negotiate or cross a trade on the physical floor of the exchange. But once that trade, that transaction happens, it has to be put up on the lit exchange. But there's no dark, liquidity providers out there. There's no dark pools. It has to go through one of the lit exchanges. So if you're putting in their limit orders, if you're putting in their orders, it's going to go to one of the exchanges.
Wow. Hello? I got you.
Yeah.
Did you ever think an hour could be so exciting?
Thanks everybody for joining us today.
Yeah, we're gonna try to make this an every Sunday show. Is that correct, Dmitry? We're gonna give it a shot.
Yep. Yeah, definitely. We're gonna try to make it every Sunday. And if you guys email me, that'll help us out with picking topics, because there's a lot of topics to cover. So if you have any requests, email them over, and we're going to try to go through the emails and see what people are asking the most, and try to concentrate on that.
Yeah, that's great. So email us at support@MarketChameleon.com. Attention Dmitry or we'll get to it, and we'll try to put together shows. Next week's obviously a holiday, but 2 weeks out, we'll try to have another show. Thanks, everyone, for joining us. I'll let everyone know the poll. Mm-hmm. What level options trader are you? Any guess, Dmitry? Beginner? What percent?
I would say beginner 25%.
Close. 38% beginner, 42% intermediate, and 22% advanced.
Okay, awesome.
Good stuff.
Thanks, everybody. Stay safe.
Wear those masks. Be safe, everyone.
Good night.
Have a great week. Bye.
Thanks.